All right, and we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Tom here with me, ready to begin his presentation on time at 2:10 p.m. That's Eastern Time, coming up in just a few short minutes. Thank you so much for your patience, and I hope you're enjoying the show so far. Hello again, and welcome to anyone just joining. This is your Money Show host, just popping in again to let you know that the next presentation will begin on time in a couple of minutes now at 2:10 p.m. Eastern Time. Thank you. Hello, everyone, and welcome to the session. It is my pleasure to introduce to you Tom Essay, the president of the Sevens Report, which he founded in 2012 with one mission to combat the information overload facing financial professionals and provide research that helps them become more efficient and effective. Now, to our live viewers, please share any questions you may have for Tom in the chat box, and time permitting, we'll get to those at the end of the session. And with that all said, I will hand the mic on over to you, Tom. The floor is all yours, but I'll be here if you need me.
Thank you very much, Charlotte, and thank you everyone for joining me this afternoon. It's always a pleasure to be here at any Money Show presentation, either virtual or in person. The title of my presentation this afternoon is How Bad Could Stagflation Be for This Market? And there's a reason that I want to talk about this today. The biggest risk this market faces is that this radical change in trade policy and in a broader view, sort of general economic policy, creates stagflation. Now, so far, those fears have gone unfounded. Tariffs have been implemented, and we are not seeing a major spike in inflation per se, although we'll go more into that shortly. Nor are we seeing a dramatic deceleration of growth. But as I often say, just because something hasn't happened yet doesn't mean it won't happen. And I have been in this business much, much, much too long to realize that timing of these events is the hardest thing to get right. And in every sort of slowdown or market upset that I've experienced over my 2-decade-plus career, I can tell you that almost all of them happened later than everybody thinks. And so one of the things I want to keep doing through our research is to make people aware of these risks. Not to be Pollyanna, not to say it's going to happen. Nobody knows whether it's going to happen or not. But instead, to push back against the idea that just because it hasn't happened yet, it won't happen. And we're going to go through that today. So before I go into any of my presentation, I think it's always very useful to know a little bit of something about who is speaking to you. So my name is Tom Essay. I am the founder and president of Sevens Report Research. I've been on Wall Street for more than 2 decades. I started my career on the floor of the New York Stock Exchange for Merrill Lynch. And in 2005, I left the floor and joined the buy side, which is what we would call sort of the money management business on an institutional basis. I was a trader for a large family office / small hedge fund, and we did a lot of different investments, and I was responsible for managing the risk of the portfolio. And during that period, I had 2 unique experiences. The first one was that I traded a whole bunch of different markets, so equities, commodities, currencies, bonds, anything the PM of the fund wanted to do, I was in charge for sort of managing the risk in the portfolio. I also experienced the information overload. We were inundated with research, and it was very difficult for me to try and parse through and figure out what was really important. What were the few things that I needed to pay attention to? So in 2012, I started the Sevens Report with the goal of cutting through the noise and being able to deliver subscribers a succinct, comprehensive, and timely macroeconomic note each trading day at 7 a.m. And that is what the Sevens Report is. And it was launched in 2012. And what makes us a little bit different is that while most publications focus just on stocks or maybe just on commodities, we get a much more 360-degree view. So every day we talk about equities, commodities, currencies, bonds, any Fed speak, like for instance, today we're getting the minutes as we speak, and we'll be covering that tomorrow. And this is important because what I realized during my position and what I've learned now and try to convey to our subscribers is that all the markets interact with one another. You can't just look at equities without knowing what's going on in yields. You can't just look at yields without understanding what's happening in the data or the Fed speak or the dollar. And it's not just here in the US, it's globally as well. And so that is our main flagship product. We now have several other products as well, but thousands of financial advisors from all 50 states and more than 10 foreign countries, advisors, portfolio managers, and investors rely on the Sevens Report to keep them on top of markets. So let's take a look at the goals for today's webinar. The main goal is to answer this question: how bad could stagflation be for this market? And I'm sure many of you know this, but perhaps not all of you. So stagflation is one of the potential consequences of the new tariff policy. The reason is because the tariffs could simultaneously slow growth and boost inflation. So stagflation is a combination word. The stag refers to the stagnation of economic growth. Think of GDP going to 0%. Deflation implies to rising inflation. And that hurts the economy in two ways. Number one, it erodes consumers' purchasing power, but it also prevents the Fed from cutting rates to help end the slowdown. So these two negatives sort of feed on each other. Stagflation is one of the worst, if not the worst, economic environments any economy can be in. And the reason is because the combination of it prevents the Fed from cutting rates to help end the slowdown, and it erodes people's purchasing power due to higher inflation, which makes any slowdown even worse than it otherwise would have been. Point being, stagflation is very bad, and it is sincerely something I hope we do not experience in the coming quarters and years. But it is a risk, and it is not unreasonable to think that the new tariff policy, the new economic policy, does breed stagflation. So we haven't seen stagflation in a really long time, going on 50 years. So the last time we had stagflation was in the mid 1970s, and there were several different reasons for why we had stagflation. The Arab oil embargo was a big reason. Price controls levied by the Nixon administration was a big reason. The Federal Reserve cutting interest rates too early was a big reason. All of these things combined together to create a stagflationary environment. And as you can see here, it was not good for equities. This is the S&P 500. From 1973 to late 1974, the S&P 500 fell nearly 40%. Right? To put it in today's terms, that would bring the S&P 500 well into the 4,000s, if not into the high 3,000s. I mean, could you imagine that type of decline? And to illustrate stagflation from an economic standpoint, here's what it looks like. So the purple line is inflation. That's CPI. Look, it goes up, right? And you can see as it goes up, stocks go down. GDP quarter over quarter is the orange line. It goes down. This is so odd because normally when growth slows, so does inflation. Right? Think about it. Inflation is too much money chasing a finite amount of goods and services, right? Well, when the economy slows, demand for goods and services also slows. So you see inflation typically decline during economic slowdowns. Stagflation is the opposite. We saw it in the 1970s, and this is really the last bout we had of it. There were other times of high inflation, but we didn't see that economic growth contraction. And so this is really the best example we have of stagflation, and it is a painful one. So let's take a look at stagflation. Are stagflation risks rising? Is there stag, right? So stagnation in the economy, the first part of the word. Well, there are a couple different economic metrics that I watch consistently. We have several different proprietary economic metrics that we pay attention to here at the Sevens Report that we contain or that we put into the report once a month. Two of my favorite economic indicators are the PMIs, the ISM PMIs, Purchasing Managers Indices. One is for the manufacturing sector and the other is for the service sector, right? That's basically the two sectors of the economy. Now, under 50 means that those sectors are contracting, so growth is negative. Now, the ISM manufacturing PMI has been basically below 50 for years, really since the beginning of 2023. Now, there are a multitude of reasons for this, but if we look at this chart, what we can see is that there hasn't been any material deterioration since the beginning or the middle of the year. So let's say about here is where we started to get our tariff headlines. We haven't seen a collapse down. After all, we were much lower not too long ago. So overall, while this is in slight contraction territory, it's holding in okay. The service sector PMI is actually more important. And the reason that it's more important is because the service sector of the economy really makes up 60 to 70% of the US economy. I mean, think about it. It's mostly a service-based economy. This is a little bit more troubling. Now, the good news is that we are still technically above 50, 50.1, right? The bad news is that we have seen quite a bit of a decline since the beginning of the year. I mean, we were above 55 in December, and now we're threatening to break below 50. So as I look at these two charts, what does that tell me? It doesn't tell me the growth is stagnating. In order for that to occur, we would need to see both of these sharply below 50. But it does tell me, at least in the service sector of the economy, that we are seeing the growth lose momentum. So growth is not contracting, but it is slowing. Two other economic metrics we follow are retail sales and non-defense capital goods, excluding aircraft. And I'll get to that one in a second. So retail sales, you can presume what they mean. It's essentially one of our best macroeconomic proxies for consumer spending, and it's strong. You don't need to be a certified market technician to tell that this is a good chart. So what does this tell us? This tells us that tariffs so far have not significantly dented consumer spending. Consumer spending is the engine of growth of the US economy. So this is overall a very positive chart. The chart on the right, non-defense capital goods excluding aircraft, that comes out of our durable goods report. And here's how I want you to think about this number. It's essentially a proxy for business investment, right? If a business is going to go out and buy a bunch of trucks, if it's going to invest in a new forge or a furnace or some sort of a sophisticated computer or robotic equipment, these are all considered durable goods. And we look at non-defense capital goods, excluding aircraft, as a proxy for business investment. And business investment is doing just fine. Again, we don't need to be a CMT to tell that this is a good chart. The interesting thing here is that there were a lot of concerns that the tariff uncertainty from earlier this year, I think April, May, March really through May, would, number one, cause consumers to tighten up their pocketbooks, to put their wallets back in their pants and wait for things to occur, and that businesses would do the same. They would shelve investment initiatives, they would hoard their cash and wait for the dust to settle. Neither of those things have happened. Finally, looking at the labor market, jobless claims remain stable and near multi-year lows. For those of you who have been in this business for more than, I would say, 5 or 6 years, 224,000 weekly jobless claims was a dream from the 2000s and 2010s. These numbers are historically low. They signal a tight labor market, but not too tight, and overall labor market health. Similarly, the unemployment rate has risen over the past, say, 18 months from a very, very low 3.5% all the way to 4.2%. But 4.2% is still historically low and implies full employment. That's not something that should make anybody nervous. So what are the conclusions? So there are clear signs that the US economy is losing forward momentum, and I can highlight the ISM PMIs and the higher unemployment rate. Even durable goods and retail sales, I could argue that some of the spike we are seeing and some of the strength is coming from two things. Number one, it's coming from retailers, from consumers, and from businesses front running the tariffs and trying to get purchases ahead of increased tariff costs. And it's also because these two metrics don't use constant dollars. So if prices are going up and people are buying the same number of units, then retail sales and non-defense capital goods, that's aircraft, are going to go up, even though people aren't buying more stuff per se. And so you have to look at these metrics with a little bit of a grain of salt. But nonetheless, you don't want to pick them apart and try and find a conclusion that isn't there. The truth of the matter is the economic data is not showing a stagnation. And that is a good thing. It is showing that growth is losing momentum, but growth is still positive. And so that, to me, is something that tells me that this is something we need to continue to monitor, because if the loss of momentum gets worse, then that's something we have to worry about. Now, what would signal stagnation? These are things for you to kind of jot down and keep an eye on at home if you'd like to look at economic data and watch economic data. So both ISM PMIs, so manufacturing and services, dropped below 50 for 2 to 3 consecutive months. That is actually a very, very accurate recession warning. It doesn't mean that a recession comes every single time, but it's pretty accurate. And if that happens, I will be talking about it in the Sevens report and throwing up a warning sign saying, listen, when this happens, usually growth begins to contract. Retail sales and business investment turn solidly negative. We begin to see month over month declines. And then jobless claims rise consistently above 260,000. Watch the 4-week moving average, not just the weekly data. And the unemployment rate rises above 4.5%. If you see those three bullet points satisfied, then the stag in stagflation is coming. And we need to think about that from a risk standpoint. So are stagflation risks rising? Is there inflation? Right? This is the second part of the word. Well, despite last week's hot PPI report, which got people all in a tizzy, most inflation metrics are pretty stable. So this is a chart of CPI, and this is the core CPI here, core PCE price index here. CPI, as you can see, declined from the great inflation out of the pandemic and has largely been bumping along. I mean, if we were to put a trend line, it's going slightly lower, right? Core PCE price index, something similar. It comes down, 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 and has now largely been chopping sideways. Look, the Fed wants these numbers down at 2%, right? Here and here. They're not going towards 2% right now, but they're not going much higher either. And so it is not true to say that tariffs have boosted inflation at this point. Getting a little more granular, within those ISM PMIs that I was talking about earlier, there are price indices in these metrics, right? And they tell us so the PMIs are neat because they are essentially surveys that are sent to management of various businesses. In the manufacturing PMI, these are surveys that are sent to management of manufacturing companies in the United States. In the services PMI, they're surveys sent to service companies in the United States. And then they combine all the answers and they score them. And that's what gives us the PMI. One of the areas they ask about is what's happening with your prices, what's happening with your prices received from your consumers, and what's happening with your prices paid, right? Meaning, what do you have to pay to get the goods you need out to market? Well, this is a little less encouraging because as you can see, we are moving sharply higher starting in about December of this year. Now, this is a trend that's been bouncing back, and we're pretty high. I mean, we are the highest we've been in more than 2 years. So that's not the greatest sign, especially since this is manufacturing, and that would be most directly related by tariffs. The services prices paid is showing something similar, and we're almost getting back to like post-pandemic inflation levels. So these are two concerning signals that push back against CPI and the core PCE price index. In fact, there are some people who are concerned that these are essentially front-running CPI and the core PCE price index, and that as these prices begin to filter into the economy, that we will see upward pressure on CPI and the core PCE price index. Finally, inflation expectations are pretty important. They don't talk about them a lot in the financial media, but they matter a lot to the Fed, and here's why. If a consumer begins to believe that high inflation is here to stay, then that consumer can then begin to try and forward buy the goods they need, not just for the next couple of weeks, but for the next couple of months and quarters. That in and of itself can actually create more inflation when it did not previously exist, right? Think about it just from a common sense standpoint. If you think the price of milk is going to go up, 2% every quarter, and you believe it, right? This is what you've experienced, and this is what you believe in. Well, then you're going to buy as much milk as you can right now and freeze it or do whatever you can to try and store it, because it will cost more tomorrow than it will today. And that increased demand can actually create an inflation problem. So inflation expectations are something the Fed really pays attention to. The good news, they're generally okay. So this is 3-year inflation expectations. Don't pay attention to 1-year inflation expectations. Those are not particularly helpful. These are a long-term metric. Now, they are elevated at 3% compared to the last, say, year and a half, but they're not super elevated. So not the best number, but not a problem either. 1 year inflation expectations by comparison are staying generally tame. Again, they're bumping along here. So what is our conclusion? Well, there isn't inflation yet. So CPI and the core PCE price index are largely stable, and they're basically bumping sideways. What they are not doing is they are not spiking in response to these tariffs as some people feared they would. However, it would be a mistake to sleep on inflation risks. Those PMI, the ISM PMI price indices that I showed you earlier are spiking. And there is a possibility that that begins to filter through to the CPI and the core PCE price index. That matters because if it occurs, then we will not get rate cuts. And that's a problem for the stock market. So what would signal inflation, right? Again, if you're following along at home, jot this down if you like to pay attention to economic data or listen when somebody's on CNBC or Bloomberg or Fox Business talking about it. So headline and core CPI both rising through 3% right now. Only core is 3% and towards 3.5% year over year. That would reflect a sort of a statistical jump in what's happening with inflation. The core PCE price index rising above 3% year over year consistently. So for more than 2 months, right? What we're looking for here is trends. Any data point can kind of spike in V, 1 month to the next. We want consistency because that tells us the trend has legs. And then finally, inflation expectations, especially 3 and 5 year, rising sharply, implying more structural inflation. If those 3 things happen, if those 3 bullet points are fulfilled, then we have a problem on inflation. So what happens if stagflation appears? Well, it's not good for the stock market. Right now, the S&P 500 is trading at about 23 times forward earnings. Typical bull market valuations between 20 and 22. Why is the market above that? Expectations for lower rates, Fed rate cuts, that boosts the multiple. Expectation for better growth boosts the multiple. And then the weighting of the large cap tech stocks in the S&P 500, they all trade well above the market multiple. It's yanking the aggregate market multiple higher. What is a stagflation multiple? 17 to 18 times, much lower. Why? Because there will be no rate cuts, so it's got to be a lower multiple. No cyclical growth. You're not going to see the economy expanding. It's going to be contracting, lower multiple, and likely return to earth for mega cap tech names, also pressuring the multiple. If we assume $260 in earnings, which is what is expected of the S&P 500 for 2025, then a reduction from 23 times, where we are right now, to 18 times would be the equivalent of 1,300 S&P 500 points. That gets you to about 5,000. And that's the top end of the stagflation range. To give you a little visual of it here on the right, that's what we're talking about down there, right? From a 17 to 18 times multiple. This is a table that we do every month in the Sevens report at the beginning of the month. It's called the market multiple table. And what we do is we list the influences on the market. There are usually only 3 or 4 that matter. And we explain the current situation. We detail specifically what would make it better and lead to a rally, and what would make it worse and lead to a decline. And then we give you a range of what you can expect depending on what happens. This has proven very useful. We introduced this about 5 years ago. 5 or 6 years ago, and it has been incredibly useful for our subscribers as far as giving a roadmap to the market at the start of each month. So what could outperform in stagflation, right? I just got done telling you that if stagflation shows up, the S&P 500 has a problem, right? But I hate giving problems and not solutions. And so I also want to talk about what could outperform in stagflation. Now, obviously, these are broad ideas. We have to get much more granular, and we will in the Sevens report if stagflation becomes a problem. But idea number 1, mega cap tech ETFs. Now, that may sound a little bit surprising, but yes, they would come down some as the market declines. But this would be one of your first areas of the market to find some value. And I'm not talking about Palantir here. I'm talking about Microsoft, Meta, Google, Amazon, the super large caps. AI is here to stay. and it's going to grow regardless of the macroeconomic environment. It's what we call a secular growth story. It exists independent of whatever is going on in the economy. If a growth story is dependent on the economy accelerating, that's called cyclical. Secular ignores the economy, and it's going to grow regardless of what's happening. And the mega cap tech ETFs will do that. Idea two, consumer staple ETFs. Price inelasticity. So that's a I don't know if any of you took macroeconomics in high school or college or grad school, but price elasticity of demand is essentially a very fancy way of saying how sensitive are consumers to price increases. Well, on goods we don't need, like potentially a third car, consumers are incredibly sensitive to price elasticity. The higher the price goes, demand falls off a cliff. What about toothbrushes, toothpaste, diapers? There's very low price inelasticity. So what that means is that people have to buy them regardless of what their disposable income is or the price. So consumer staples can hold up well in stagflation. Floating rate debt ETFs, another one. Short-term rates will ratchet higher. You want to have floating debt to ride that increase. And then finally, commodities, natural resource ETFs, gold, silver ETFs. Higher inflation will support natural resources. These are things that cannot be devalued, right? They are physical goods, including gold. And so that's sort of four broad ideas that people should consider. Just jot them down. Again, we are not in stagflation. Stagflation is not imminent. I don't think it can be dismissed either, and hopefully I've demonstrated that to you over this presentation. But these are four ideas just to keep in your sort of the back of your mind and your back pocket if people do start getting nervous about stagflation. For those of you that are interested, that have enjoyed the presentation, we do offer a complimentary free trial of the Sevens Report. It's a 2-week free trial. All we ask for is your email. We add you to our subscriber list for 2 weeks. You get the exact same experience as a paying subscriber. And then at the end of the 2 weeks, if you choose not to buy, you just get removed from the list. No credit card required, only an email address. And please visit sevensreport.com to start your free 2-week trial. And with that, if we have just a few minutes left, if anybody has any questions, please let me know. I'd be happy to answer any.
Fantastic, Tom. Thank you so much. We do have a question here from Rob. He asked this earlier on in your presentation. He said, how should the Fed look at the next 6 months? What's happening to the job market for new qualified entrants?
Well, that's a very complicated question, Rob, mainly because of AI. I think that people are concerned that AI is going to take essentially your average bachelor degree person out of college is going to begin to see their jobs go away because of AI. Now, I don't think that's while that's a complicated problem over the longer term, for the Fed, I think that's sort of down the list on problems they have to deal with in the immediate term, because they are under enormous pressure to cut rates. There's sort of a mutiny, it would appear, going on in the Fed. Yet at the same time, as I just demonstrated to you, I think it's hard to say with confidence that there is not going to be an inflation scare. So I think what the Fed ends up doing is they will cut 25 basis points in September. They'll probably cut another 25 in October or December, and then they will sort of see what happens. They can cut 25 or 50 right now, and I don't think that anyone would think that they're becoming stimulative. So if inflation becomes a problem, they can simply stop and let still higher rates kind of do their thing. So I do expect they will cut 25 basis points. I expect they'll cut a second time by the end of the year, and maybe a third time if growth all of a sudden takes a nosedive.
Thank you very much, Tom. I do have I think a question in the chat here from one of our attendees. It's quite long-winded, but I think she's asking essentially, how do you alert individual advisors in the US about the AI promotion in stock portfolios and stagflation for the US economy? I'm sorry, little bit of a long-winded one here. Monica, I may need you to reword that if you have a question for Tom. I do apologize, but we do have another minute here, Tom. So just while we still have the audience with us, I wanted to ask you, what are some important tips that you would like to share with those who are in attendance today? Anything that you think is going to benefit them going forward for the rest of this year?
Yeah, I think that the market is going to become more volatile. And as I said at the beginning of the presentation, my biggest thing is just because something hasn't happened yet doesn't mean it won't happen. It's hard to uh, sort of there have been such massive changes to the U.S. economy here in the last couple months, and these are going to take time to filter through. I mean, aggregate tariff rates are the highest levels we've seen in like 80 years. The world economy is obviously very different than it was 80 years ago. No one knows how this is actually going to impact anything. I mean, people say they do, but they don't because nobody was doing this 80 years ago. Meanwhile, there are a lot of other forces coming into the economy at the same time, including AI, automation, massive capex by large scale tech companies. So I would encourage everyone to brace for more volatility and be aware that there are sort of tectonic movements occurring. That doesn't mean they will end up negatively, but this is not a time to simply index and ignore. We do need to pay attention to what's happening in the markets and make sure that things are unfolding in a positive way for the medium term.
Well, Tom, thank you so much again for joining us and for getting some answers for our audience questions. I know they appreciate it. It's been a pleasure having you on the show today.
Thank you very much, Charlotte. Always a pleasure to come on the Money Show.
Absolutely. And to those of you watching live, be sure to stay tuned. We do still have a couple more sessions in store for you today in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.